Boy, so Federal Reserve Chair Jerome Powell made some interesting remarks at a conference in Florida this week. A lot of people have been talking in the last year about the obvious bubble in corporate debt in the U.S. financial sector. Corporate debt has in large part fueled the stock market because companies have been able to borrow a lot of money at really cheap interest rates and buy up their own stock and drive up the stock market. Now, of course, this kind of behavior is unsustainable because borrowing money to buy back your own stock does not yield really any investments for these companies. It's not like, say, investing to expand your actual business. You're not going to increase your cash flow. So then that, of course, begs the question, well, if this debt is so unsustainable, why would banks and other financial institutions keep lending money to these corporations? The answer to that's pretty simple. It's because the banks and other financial institutions don't hold on to all this corporate debt themselves. They package it and resell it to investors. So then the question becomes, if the banks don't care because they're not going to hold on to the debt for long enough to really see these folks eventually default on their debt, well, then why would the investors buy them? Because isn't that a pretty bad investment if it looks like there's a big chance that these non-yielding investments made using corporate debt could one day be defaulted on? Well, the reason why investors are still interested in corporate debt, even knowing all this, to the extent that they do. I mean, I'm sure there's plenty of investors out there that are pretty blind, but those who do see the risk are willing to accept it because they are chasing yields. Yields on government debt, for example, which is generally considered to be safer than corporate debt, is extremely low. Yields on pretty much all bonds are relatively low, in terms of where they've been historically. And that's, of course, because the Federal Reserve has kept interest rates astronomically low for a decade. Credit, because the Fed prints money and injects it into the credit markets, credit is extremely cheap and abundant. And that means that investors who want to make a decent return can't do it by making safe bets or safe loans. They have to invest in riskier assets like, say, this corporate debt, which appears by most accounts to be a bubble. And certainly, in my opinion, it's very clearly a Fed-fueled bubble because the Fed, every time they decide to lower interest rates, always end up blowing a bubble in the credit markets. And it's for this exact reason the banks are in the same position. The banks, in order to make the same amount of money, they have to loan to a lot more people because they're loaning out money at much lower rates. So therefore, they have to ease their lending standards so that they can make loans to people who are far riskier just to make the same return. And so, of course, a lot of people have been drawing comparisons between this obvious corporate debt bubble and the housing bubble of the early 2000s. And who can blame them, considering that the circumstances are almost identical, except if you substitute, housing for corporate bonds. Now, Jay Powell addressed this line of thinking in his speech, and he actually agreed, surprisingly enough. It's kind of refreshing to hear that kind of honesty, even as minor and insignificant as it may be. So in his speech, Powell identified the risk in the market essentially being in mutual funds which own collateralized debt obligations, or CDOs, which consist of corporate debt. And the translation of that is that basically there's a lot of individual investors out there who don't want to own stocks because they're too risky, but they also don't own own government bonds because they have too low of a yield. So a lot of individual investors own corporate debt, and therefore, if there are some defaults in the corporate debt market and those assets, the CDOs, start to lose value and people get scared, well, then you could see a mass exodus from the market by individual investors selling their shares in these mutual funds, which then, in turn, the funds would have to liquidate all of their corporate debt holdings. Now, in my mind, that would be disastrous because what ends up happening then is if you have all these funds and all these people liquidating their corporate debt, well, then there's not going to be enough buyers to buy up all that corporate debt at the established price. The price is going to plummet, because there's going to be a huge supply of all this corporate debt. Now, if there's a huge supply of existing already issued corporate debt in the market, well, then banks are not going to be too interested in issuing new corporate debt because the banks then will not be able to then take those loans and resell them and package them and sell them on the secondary market to investors, since investors already have a huge supply of corporate debt based assets to choose from. So what this will lead to then is illiquidity in the corporate debt market. Companies will have a much tougher time getting loans for their businesses. And to the extent that they are going to be getting any more loans, they're going to probably be at higher interest rates, because the only way that the banks issuing this new debt could compete with the debt that is already out there in the open market that is quite cheap is if they offer higher yield debt. So then by extension, if corporations have a tougher time getting loans, if credit is not quite as cheap, well then you're going to see a big sell-off in the stock market, because these companies, their operating costs have just gone up quite substantially, so they're not worth as much. These companies won't be as profitable, and therefore you're going to see a lot of air come out of the stock market. It's this corporate debt bubble which has largely fueled the bubble in the stock market, and so therefore if the corporate debt bubble pops, stocks will follow. And of course, if individual investors who own stocks see their portfolios and their 401ks plummet before their eyes, well, then they're going to have to tighten their belts, because they're going to know that, hey, all of a sudden, this big pillow cushion of a nest egg of a retirement account that I thought I had, all this money that I used to have, that I thought I would have in case I needed it, it's gone now. So I'm going to have to tighten my belt financially and not spend as much every year now, and make sure that I save more money. And this is what central bankers fear the most. Central bankers hate people who save their money. The so-called recovery, which Bernanke was the architect of after the 2008 crisis, really was not a recovery at all, but rather a scheme, an elaborate scheme to make people feel richer so that they would spend more money and consume more. So essentially, we had a debt bubble created by Bernanke, which created a consumption bubble. This whole recovery was not about saving and investing in new projects in the economy and growing the economy in a sustainable way, but rather by just getting to people to spend as much money they could in the short term so that GDP looked higher. The recovery after 2008 was not a recovery so much as it was a relapse. The economy in the early to mid 2000s got drunk on cheap credit from the Fed, and in 2008 they puked their guts and they purged all that toxin and all that alcohol poison, but then they woke up the next morning and went straight back to drinking. Now, if you ask me, it's pretty clear at this point Powell's turning into a pretty big dove. Not shocking, I think pretty much everyone at the Fed is a dove by my standards, so that means that we're going to see QE4 sometime, it could be before the next election, frankly. It's impossible for me to call the timing exactly when this corporate debt bomb could blow up. I mean, it could be in another 3 years, who knows. But when it does, QE4 is not going to be buying up mortgage-backed securities like in the last crisis. They're going to be buying up corporate debt. Corporate debt, it seems to me, is the epicenter of the bubble. It's by no means the source, but it will be the spark. The source, as always, are the firemen at the Federal Reserve who think they're putting out fires and trying to extinguish them by hosing these crises down with gasoline. And until their tactics change, we're going to continually go through these extremely cyclical economies with big booms and even bigger busts. So I don't have much hope that after this next crisis that things are going to get any better. But in other words, this is a whole big mess, and the Fed has distorted the system to such an extent that only a serious crash could correct any of this. There's a huge imbalance between savings and investment, and the Fed has effectively divorced the two. Even though in, basic economic theory, the two variables should have a one-to-one positive relationship. And so, in my opinion, this is pretty much exactly like 2008. I think those comparisons are pretty apt, and it shouldn't at all be surprising to anyone that we've ended up here, because the Fed, since 2008, has pursued the same policies that they did prior to 2008. So if you gained anything out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you back here tomorrow.